The Fed has always been late to the party, right? They need to see many quarters of economic growth before it finally dawns on them that they need to raise rates. So why now are they early? Is it politically motivated? Joining me right now, BMO Private Bank Chief Investment Officer Jack Ablin, BGC Partners Senior Advisor Steve Cortes, who was also an advisor to Donald Trump on the campaign trail, and our very own Nicole Petallides, who's down there at the New York Stock Exchange. Steve, I'm going to start with you. You know, look, I'm no fan of low rates, and my fear about a low interest rate environment is that you can create other kinds of bubbles by making money too accessible and too easy. You also, you know, when you talk about incentives, can in some ways dampen incentives because people know they can get money 6 months from now as opposed to needing to borrow it and invest today. But at the same time, I do wonder why it is that the Federal Reserve has repeatedly been late, consistently, and now they want to be a little early. Are there any political motives here?
Well, of course they are. This is a human institution run by human beings, most of whom, by the way, have a predilection towards central planning. And so I think they absolutely were trying to protect President Obama. I think had Hillary won, they would try to protect President Hillary Clinton. They don't have that natural hindrance when it comes to President Trump. But look, here's the funny thing, I think. President Trump and Janet Yellen, there's probably no love lost between the two. I doubt they're going to be vacationing together at Mar-a-Lago. But guess what? They both, to an extent, need each other. Because you're right. We do need higher interest rates for the right reasons. And by the way, Janet Yellen probably wouldn't admit this, but the optimism that's out there, the acceleration in corporate earnings that's out there, small business surveys, hiring, wage gains, everything that's happened since the election is allowing Janet Yellen, at long last, to start to normalize interest rates.
I'm just asking, Steve, don't you want to let it go a little bit longer? I mean, don't you want to see that start to accelerate a bit more before you put the reins in on everything?
Yeah. I think we're ready with this major caveat. We're ready as long as we get the tax package through this year. Because if we do that, I think the economy right now in the United States is a slow burn economy. If we throw gasoline on it, which is the tax cuts, we're going to have a bonfire economy. And I think that's coming. So then we can raise rates on a sustained path as long as we get the tax cuts.
I hear you. You know what? If those tax cuts come through, you are right. That is going to mean a lot to the market. It's going to mean a lot in terms of investor psychology and everyday American psychology. What are you hearing down there on the floor, Nicole?
Well, when you talk about the Fed, I mean, we know that they've really held these rates. They only raised in last March, and so June and September we're likely to see these rate hikes. But what's interesting is while there's an 87% chance of a rate hike in June, what will they do in September? And to your point, Trish, the question is the Fed and the political game as well. First of all, the balance sheet is #1 front and center on Wall Street. It is something that it is being spoken about. It's $4.5 trillion. When will they begin to unwind this balance sheet? First of all, the other thing that they've been doing is as these assets mature, they're reinvesting the money back in, which really holds down long-term rates. Now, the question is how will they unwind that? And that in itself could bring some uncertainty and turmoil to the markets. And that's curious, and we'll see what happens with that.
Well, Jack, you know, we know that the Fed wants to guard against inflation, okay? So they're watching wages very carefully. They're watching all the PPI and CPI data they can get their hands on because they want to see if there's any inflation in this economy. I got to tell you, unfortunately, there really hasn't been much. You know, and as such, I once again go back to why is the Fed choosing to be more aggressive right now when everyone knows it is much easier to stop and to slow a growing economy than it is to get one going.
Absolutely, and actually for that reason, I think the Fed is dragging its feet. If you look at, for example, the overnight interest rate relative to inflation 18 months ago, the overnight rate was between 0 and 25 basis points, a quarter of a point. Inflation was essentially 0. Since that time, the overnight rate has gone to 1. Inflation is now running 2.5% year over year. So relative to inflation, which is also a key driver of currency, remember, that's one thing Chairwoman Yellen and President Trump agreed. They don't want to see the dollar go up. Relative to inflation, interest rates are lower today than they were 18 months ago. In fact, real rates, interest rates minus inflation overnight, is lower here than in Japan.
Yeah, all right. I apologize, guys. We got to leave it there, but all very good insights from each one of you, Jack, Steve, and Nicole.